Hello, this is Michael Prestwich, President of ImagiSOFT. In this segment, I will show you how to present the Roth IRA to your clients. Let's start with the first presentation. By its very nature, the Roth IRA is at least a two interview sale. And so let's go over the information that you would have gathered in the first interview. So you can see we have the name, we have the age, we have an assumed age at death, which we have a calculator, you can use that. The Roth IRA works the best the longer people have to accumulate. So the longer that you put here, the older that they live, the more suitable it is for the client. You notice the spouse is 55 years old with a life expectancy of 96, so she will outlive her husband by about 20 years. Believe me, the wife in this case is going to be the one that drives the sale. The other thing you ask is information on income. You notice we have the Social Security, defined benefit, and so forth. It's easy to enter this information. It does not take very long. Another thing we ask is the filing status, their itemized deductions. Then we look at asset information. So they have $50,000 in money market, 370 in CDs, $1 million in the 401k IRA traditional plans. And lastly, we ask what is their main objective? To have a larger estate for posterity, higher income for the spouse is also an important consideration. So now that we know more about the client, we've gathered information of what they're trying to accomplish with the Roth. Let's see whether or not it's suitable. So to do that, we go into the Roth IRA software. What people like about our software is it's very, very simple and straightforward. It's pretty easy. Here's the bottom line. Mr. and Mrs. Sample, if you were to invest $342,000 with the expectation that over your lifetime and the benefit to your children would be $7.4 million, would you do it? I mean, that's really the basic proposition. Is it worth it to come up with $341,000 now? And that is, in this case, it's to spend these assets, these low-yielding taxable assets, to convert this $1 million IRA asset to a Roth, and that's the benefit. Now, where do those numbers come from? Obviously, if you're evaluating our software, you want to know where those numbers come from. The other thing, obviously, the client wants to know where those numbers come from. Okay, where is the benefit? By putting in your income information, you notice this right here is the cash flow. We have you, 65, John. You're retired. You have income coming in. And the IRA that you have, the $1 million IRA that you have, all of a sudden at age 70, you notice that we have income that you don't want. You told me in your initial interview you could live on about $150,000 after tax, which you're above that situation right now. And when you get the required minimum distribution, it pushes you up to about $250,000 of income, a lot of that, which raises your taxes. So that's one problem we have in the current situation. Then we see your wife retiring. Then you continue to live, and we assume you pass away at age 86, and then your wife lives 20 years alone, and her income drops. So that was a secondary concern you have, is that you have the income going down. Now, let me ask you a question. If you could get rid of this problem right here, where you have income you don't want to take, and then shift it out here to where your wife receives that income, would that be more suitable? Would that be better for you? Of course, the wife is going to say yes. So I said, let's look at the Roth conversion. You'll notice that at age 70 there is no required minimum distribution. Your income remains kind of level, but it drops when you retire, and then you notice it goes up after your husband passes away. Now, why is that? It's because we've shifted the income out here. Look at the red. The red in these areas is the tax area that you pay. So we have the total cash flow on the before and after. They're virtually identical, but look at the income taxes. 1.4 million versus 800,000. That's about $600,000 difference in taxes. I don't have to ask you, do you mind if I save you $600,000 in taxes? No, I don't think you mind that at all. Okay, so the total discretionary income, that's the blue area right here, while you're alive, is $6 million on the before side, 6.6 million on the after side. Again, I don't have to ask you which you'd rather have, correct? Okay, the remaining assets when you pass away is $1.4 million. That's what goes to your children on the before side. On the after side, $8 million. Okay, why the difference? Let's look at this. You told me when I asked you about this 4% return that a few years ago you changed to a much more conservative type portfolio. You're afraid of losing your money, and that is a genuine risk. But let me ask you another question. Aren't you really saying you want safe, secure, conservative assets for you while you're alive? Does it really have to be safe, secure assets for your children while they're alive? I mean, think about it. If you lost all of the children's money, I mean, they'd be sad, but they're not going to be out really anything. So that's a change that I made. Is I basically took your IRA and put it, instead of one big 4% account, I put it into two accounts. First one, and I'll just show you that by doing this edit button. The first one is we put $500,000 into a hypothetical fund at 8%. We use the current assets to pay for that. We pay it in 2010, and we have income options of none. In other words, just let the money grow as long as it goes there. There's never been a 35-year period where the stock market hasn't done at least 8%. Not that the past is going to reflect the future, not that there's a guarantee or anything like that, but can you accept the risk at this time of having a 8% account for your kids? Okay, they said that makes sense. We've separated that out. This account is for the kids. So they agreed with that. Now the second one, we've chosen a large, very large insurance company, the largest of its kind. I've called this one Wife's Income. We selected from our list here the Allianz product, the Mastered XX. The reason that I did that is, first of all, it has a 10% interest bonus, so you're guaranteed to get 10% the very first year. The history of the company is good if you keep it for a long period of time, and it's designed to have safety. So the primary purpose here is safety, not growth, income over growth. And so using a conservative rate of return, I'll show you what we did here. We have a specified amount. We did a view. You notice we just leave this thing alone for 20 years. Then starting at age 86 after you pass away, whenever that is, John, then we start doing a withdrawal. We do a $100,000 withdrawal, increasing by 3% inflation every year. And that's why you see this the way you see it right here, starting right here, increasing the 100,000 increases. So this way we've shifted the income that's required on the left over to the latter years, have the total cash flow be the same because it's Roth assets, because we're prepaying all of the taxes, then it makes total sense. And then you can see why we have the remaining assets of $8 million up here. Now, some people might say this is not apples and apples, it's apples and oranges, and I have to agree with them. So let's go ahead and just edit that and do a select, drop it back to 4% return. And as you can see, it still is more than double the amount of money that your kids end up with, and there's still a $2 million benefit. So now we have safety and safety instead of a pie in the sky kind of look. So the concept of the Roth makes total sense for you. Let's look at another view of this, the asset balance. You can see what you're trying to do. The assets on your current Roth IRA have almost like a mortgage. Think of the Roth IRA, or not the Roth, the traditional IRA as being a house with a mortgage on it. You don't have control over it. There's the government telling you when you have to take money out. There's a required minimum distribution. And if both of you died in a common accident, this red part is what you have to pay. But at some point, this very end is the red part that your kids have to pay at the end. So what we're doing with the Roth is it's essentially a pretty easy proposition. Is it worth it to pay $341,000 now to protect all of the taxes? That's all the taxes you're ever going to pay on your Roth IRA. It saves you $1.4 million in taxes while you're alive. It saves you this red part right here, another $100,000 or more to your children after they die. They could continue to stretch that and have tax-free income for their whole lifetime. If you want me to show you that, I can show you that. So is it worth it to have this $341,000? Most people would say yes. What's the benefit? Well, we showed you the income benefit. You don't have to take the income for 20 years. And when you do, look how much advantage you have over it, and that's using the 4% fund. If we change that to instead of an 8%, if we just did a 6% fund, depending on the amount of risk that you feel like you can put on the kid's portfolio, it makes a tremendous difference. It's huge. It makes a huge difference. Okay, let's look at the tax calculation. Where did this $341,000 come from? Well, the difference that this software has is it shows you actual tax calculations. The reason that we're recommending that you take this $1 million and put it in the 2010 tax year is because taxes go up in 2011 and 2012. Let me demonstrate. Here's $1 million added to your 2010 income tax return. Here's your current one at $27,000. Here is the new one with adding $1 million to it, $369,000. This number subtract this number equals this number right here. So as you can see, the first part is taxed at 10%, then there's a 15% bracket, then a 25%, and a little tiny sliver of 28% bracket. If you drop $1 million on top of your income, then it fills up the 28% bracket. It fills up the 33% bracket, and most of it's taxed at 35%. Let me show you what would happen if we did it in 2011 and 2012, as most journals, when you read articles, they say, oh, it has this added benefit that you don't have to pay your taxes till 2011 and 2012. Well, you could consider that a benefit, but it's not really. You notice the total cost is now $372 instead of $342. There's a $30,000 increase by doing that. Let me show you why. Here's 2010. Again, you have a little sliver of the 28% bracket. Then we drop half of it, $500,000 on 2011. And you can see there's no longer a 10% bracket. There's still a 15, but the 25 turns into 28, and we have the 28 turning to 31. We have a 36 and a 39.6. Most of that money gets taxed at a 36 and a 39.6, whereas if you do it in 2010, the top rate is 35%. That's why some people say, are taxes on sale in 2010, or more precisely, is 2010 the last year the taxes are on sale? Go to 2012, it's almost identical. And so adding the differences between this and this together in those 2 years gives you this. So when we talk to your accountant, we'll point out this and we'll see if he or she agrees that they should pay it you should pay those taxes in 2010. Okay, what is the benefit? You can slide this along. You can see, let's go in 2012, the taxes are lower by $2,000. We go in, they're lower again by $2,000. Then we have the RMD. The RMD is almost all taxed in the 31%. The tax difference is $17,000. And just keep going. You see it's dramatic, and it's bigger and bigger every year. You can look at it another way. Let's look at the ledger, and you can actually see what's happening in those later years. It's really unfair what happens to your wife tax-wise. Look at this right here. You're at 86 years. You have $262,000. You pay $50,000 in taxes. Then you pass away. Her income drops. On $170,000 at age 88, what you would have been your age 88, she still has to pay $31,000 because she's single with one exemption instead of married filing jointly with two. Look what the Roth does for her. We give her $226,000, yet she pays half the tax of what she would have paid on the 170. Now, if I don't know if that doesn't show the miracle of Roth more than anything else, but it's absolutely incredible. For her, after you pass away, the Roth is just like magic. It drops her taxes down dramatically. And if there's no other reason that you should have a Roth, that's what it is. Thank you very much for taking the time. There's other areas that you could look at in this as far as, and we'll cover those in other presentations. There's an emergency fund, which is another reason a person should have a Roth. But as you can see, the ImagiSOFT software makes it very, very easy to explain the advantages of having a Roth IRA to your clients, and it also gives you very, very accurate numbers. One of the people that endorsed our software here liked this detail page. You can actually go in and see every asset and every moving part. You know, here's the income, here's the Social Security, here's how it's taxed, here's your savings and money markets, how its income is going in. We show the income tax assumptions every year. You can see here's married filing jointly and the adjusted gross income, taxable income, and so forth. The CPA can understand this. You as a financial advisor can understand that, and your clients, if they're detail-oriented, can understand it. There's everything you need to show whether or not a Roth IRA works for your client. Now, to get the software, you can go to our website, ImagiSOFT.com, go to the install. Then all of our software has a 7-day trial. So here's the Roth IRA. Click that. Then just click the red section right here, and you've got it. When that opens, I'm using Firefox, so it has saved the file, and then it'll give you where the file name is after it's downloaded, and then you can click it and set it up. If you're running Internet Explorer, it has a run option right here. That's the one I recommend for Internet Explorer. Just simply press run, and it'll install the software. When you're ready to order, when you're in the software, go Help, About, and there's an order link. It takes you right to our secure ordering system that's online. If you look at the ImagiSOFT order page, you can see that it has the little security. Tells you that you're in a secure website here with Internet Explorer. Simply add that to the cart. It's $600. Go check out now, and then put in your credit card and name information. The information that you put in, the name would be the name on the card, the email that your credit card company has, address, and so forth, telephone number. And if you have any questions, please give us a call. Our phone number is at the bottom of every page, and that it's also in the software right here on the Advisor tab, 877-510-4702. You can also click the Help, About, Support, and if you click that, you can send us an email. Thank you very much.